Alphabet with a 6% pop is holding tech together after Supermicro's accounting revelation has NVIDIA down. Let's talk some earnings. Let's do some trading. Joining us from Wolfe Research, Shweta Khajuria is a managing director covering global internet. And Alphabet certainly is a big part of the global internet. Shweta, welcome back to the show. Tell me about the numbers here from Google and how important it is that that stock is rallying today.
Yes, well, thanks for having me. Google had a beat across the board, really, when we think about all the segments, especially search, YouTube, and Google Cloud. But the beat came predominantly from search, subscriptions piece, as well as cloud. Cloud was a big surprise. Total revenue on a net revenue basis was up about 2% above where the expectations were. And the operating income was about 7 or 8% above where the expectations were. So it was good quarter all in. They don't quantify their Q4 guidance. But heading into the print, we were leaning in positive, because of the valuation gap between Google and Meta is kind of widened, and versus the S&P 500 as well. And the setup was friendly because all the ad checks were coming in positively. So search held really well. Google Cloud did very well because it accelerated, and operating margins also expanded. So all in, really good quarter. And also their commentary around AI and Waymo was also encouraging, where AI overviews will be now launched in 100 different countries with 1 billion plus monthly users. And they're also integrating advertising in AI overviews. That's somewhat of a bear case in terms of when we think about search and its share and Google's share in the mid to long term. So it's headed in the right direction. The question now is, yes, it was a good quarter. The question now is, what do we think in the next, several quarters, near to midterm outlook? Bears are still worried not only about the DOJ case, but also about the search share against Perplexity, ChatGPT, and all those conversational AIs. But also there is this focus on capex, where Google did not quantify capex spend for next year. But if you look at where the consensus is, we think that it is conservative. And so there could be some risk in terms of the level of investment Google makes in capex next year.
Okay, I love that rundown of the stuff that is multi-pronged for Alphabet. So search sounds like they're playing a little bit more defense than they're used to, but still have a decent moat. It seems like a fair way to say that. The cloud part, I'm wondering, Shweta, how much implication does that have for cloud companies in general? Is that Alphabet growth, which is pretty impressive for cloud, showing the pie still growing for everyone, or are they taking some market share from some of the other leaders?
Well, it seems like it's a bit of both. It sounded that the growth that they are seeing is predominantly driven by their AI services that are doing really well. Sundar actually pointed to 5 different things within cloud and related to AI that are driving their growth rate. So certainly the market is expanding as more and more enterprises adopt and integrate AI onto their platforms, and there's demand for compute and inference. So they certainly are shining. But at the same time, given that where we think that the overall cloud market is growing, and they are growing significantly faster, they are seemingly taking some share. It doesn't have to be from necessarily all from AWS and or Azure, but they are taking some share from perhaps some of the other players. So it seems like it's a bit of both. The more important thing also is that the 10Q is where they disclose the backlog number, and that came in pretty strong, which is an indicator of how much demand that they have. And the other thing is also that the read-through for, I think is where you are going with this, for Azure and Amazon is actually quite positive for cloud, because the demand trends seemingly, especially represented by the backlog number, are good, which should bode well for both of them.
All right. Hey, Shweta, real fast on Meta real quick. Give us a little preview, 40 seconds for the earnings.
Yeah, Meta, the read-through from Google print is actually positive. We think that it's going to be a beat and a raise. We think that the ad revenue for the fourth quarter guide, consensus is looking for 45 billion plus. We think they'll come in at 46 or 47 billion in guidance. I think that the biggest question post the print is not just the revenue growth, but the capex. And to any degree that the CFO can talk about OPEX and CAPEX for next year is going to be helpful. We don't expect a quantified guidance, but some commentary would be certainly helpful for the stock. And that's it.
All right, Shweta, great stuff. Thank you so much. Excellent
Thanks for having
recap
me.
of Alphabet and really good preview there for Meta. All right, Tom, let's do some trading then. Shortest price target for Alphabet was $200. Now it's $220.
Yep.
So let's get some love on this thing. How are you going to trade it day after earnings?
Well, implied volatility levels crushed, right? Not only because the stock's up, but
Crushed.
because that's typically what happens post earnings. So I looked at a directional play to kind of back up Shweta's, analysis here. If you think it's going to go higher, but I gave myself a little bit of duration on this one in case maybe the overall market stumbles. I mean, Google Alphabet is definitely not immune to maybe a pullback in the overall market. So looked at a call vertical where I can offset some of my costs with the expectation the stock goes up, but I want to sell something above what I'm buying just to offset some of that risk in this position. Going out to the December monthly cycle, so you've got 51 days to expiration on this one. Buy the 180 strike call, just out of the money to the upside here, and then against it, sell the 195 call. So you're buying a bullish $15 wide call vertical to the upside. You're paying roughly about a $5 debit. It's actually probably a little bit lower than that right now. But the debit you pay is your risk. So you're risking 1 to make a potential 2 on this one. So your risk reward set up really good on this type of directional biased position or strategy that you're looking at. That break even of 185 over the next basically nearly 2 months, that's only just above 3% above or 3% above the current share price. So you don't need a monster move. You're giving yourself plenty of duration. And you have more flexibility with strategies like this where, hey, if this stock shoots up to 190 prior to expiration over the next 51 days, you can start parsing your position if you have multiple contracts on or close the whole thing. So it gives you a little bit more flexibility as far as trade management goes.
Okay. All right. So a day 2 trade. I think that makes some sense here. For Meta, ahead of the report, what do you see in the option?
Well, implied volatility levels elevated at this point. They're expecting about a plus or minus 7% move in the shares either way. So what happens is going into earnings, volatility in the near-term options really elevated compared to the other option series. So I looked at a strategy that's bullish here also, where I think she's got a price target of about 670. On this with an outperform rating. So if you think that's what's going to happen, let's look at a call diagonal in here. I went out to the November 15th monthly cycle, so just 16 days to expiration. Bought basically the at-the-money call, the 595 strike call. Then against it, and the November 1st weekly options that expire in just a couple days with that higher implied volatility, sell the 640 call. That's about that 1 standard deviation move to the upside that the market's pricing in at this point. So if you think it's going to go higher, this type of strategy takes advantage of it. So it's a $45 wide bullish call diagonal, right? But I'm only paying roughly about a debit of $21.75 for it. That risk is what you pay on this type of position. So you're paying less than half the width of this call diagonal. That's pretty spectacular, right? Break even about 605 to the upside because you do have a lot of option premium in that 640 strike call you're selling November 1st weekly cycle. But the key here with this type of strategy is you have that bullish assumption, but you're buying basically about a 50% implied volatility in the November 15th 595 call, and then selling about 125% implied volatility on aggregate in that November 1st weekly 640 call that you're selling. That's why it's such a lower priced call diagonal for the width of the call diagonal.
That's fun. Okay.
Yeah.
All right. So some little juicy options set up into Meta for sure. All right.
Yeah.
Cool. Thanks, Tom. Appreciate the trip.